It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Managing Your Financial Future, that's the name of the program. We also do what we can to educate you, and this is one of my favorite things to do. I've got a whole family full of teachers. Goes back at least 2 generations. And one of the things that I really enjoy doing is helping to educate people on things that they may have heard about, things that they thought they should have known or maybe knew something about, but really didn't. And one of the things that's important to understand, to know in finance is that you don't always know what you don't know, and that can hurt you down the line. So I want to talk about this. I am the podcast host. I am the moderator, not an advisor in any official capacity, certainly, but this guy here, Professor Rick Plum. Welcome, Rick.
Good morning. Good afternoon. Whatever time of day you're listening.
I don't know. Somebody told me they listened to us at like 2:00 in the morning. I got an email once and they had a question and they said it was like 2:00 in the morning wherever they were. So yeah, you can listen.
Whatever it takes to get you back to sleep. Well, okay. No, I'm kidding.
I almost made a crack like that and I thought, no, I'm not going to do that. Wherever you happen to be listening. But Professor Plum, you are a certified financial planner, professional CFP, as they call you, and you've been doing this for a long time. I've said this for many, many years. We've been working this show for a really long time, more than 20 years, over our TV and radio days, and even going back to our early 90s when you first kind of came on board on the media all those years ago. We are, I think this year, my goodness, this year, I'm going to have to check. I believe we're going to hit our 30th year.
You will. I don't hit 30 until 2023.
Okay, so yeah, you were a couple years later, but we started this. I mean, way back in when we were just on the radio for 1 hour. Right. That's right. In 1991, it was around the Gulf War time, Gulf War I, which seems so long ago. So yeah, we are coming up on 30 years. I'm going to have to check that date. But anyway, that's neither here nor there. What is here is I talked about education and I talked about helping people understand things that may have been confusing to them, or they didn't know that they didn't know about it. Now, last week we talked a little bit about gifting. In fact, we dedicated our entire show to gifting, and I think we cleared up some of the confusion. Now, here's one topic that really gets a lot of scrutiny, and there are a lot of people on both sides of the coin, both sides of the argument. And that has to do with annuities.
The word itself can make people cringe, or some people love them.
Salivate. I mean, it's, yeah. There are people who love them and tell you that they'll fix every financial problem you ever had, and usually they're the ones who are selling only annuities. And then you have others who say don't ever buy one. They buy all kinds of advertising to tell you don't ever buy an annuity. And Professor Plum, neither of those is true, I would say. Correct?
Correct. I mean, it's a financial product. For some people, they work very well. For others, they won't work at all. And it's like any other tool. And we've talked about this many times. If you use the tool correctly, you can get a desired outcome. If you use the tool incorrectly, you might get an outcome you like, but more likely you're going to get an outcome that isn't fitting what you thought it was for because you didn't use it correctly. Yeah,
you may have wasted your money.
Unfortunately, they tend to be sold incorrectly a lot.
Well, and yeah, we may get into that. It's important to understand that. So let's give people sort of a basic understanding of annuities. Some people hear this and they say, you know what, I've heard this term. I don't even really know what it is. To me, to the average person, rather, an annuity is like, okay, I think it's just a string of payments. Let's talk about what they started off as.
Well, that's what an annuity started off at for the most part, was a string of payments, a stream of payments. And I hear people referring to their pensions as my annuity. They'll say, yeah, I've got this annuity. And it's like, oh, where'd you get the annuity from? From the federal government or from the state, the city, the whatever, municipality.
Oh, pension.
And so I get my the pension payment is a stream of payments. It's an annuity. But it's not one that they went out and bought with money that they had in their hands. It's one they bought with years of service to the employer.
Yeah. So if I don't have one of those pensions, I could purchase one, technically, is what you're saying. I could hand a chunk of money over to an insurance company, which is, you were saying this is how it started. What? You would hand the money over to the insurance company, and then what would happen?
Well, basically, yeah, you give them a block of money and they guarantee a stream of payments for a predetermined period of time. It might be, a 10-year period, a 20-year period, or it could be for your life as long as you live or as short as you live. And so you give them $100,000 and they give you, $7,000 a year. Now, the amount of money that you're going to get from a payment standpoint depends on how old you are.
Sure.
If you're 20 years old, you're not going to give them $100,000 to get $7,000 a year for the rest of your life, unless you can prove that you're not well. But on the other side, if you're, 65 years old and you give them $100,000 and you think you have longevity, it may be a reasonable thing to have that guaranteed income for the rest of your life. You like having enough money along with your Social Security to pay the bills. You're always going to have some money coming in, regardless of what the market does or does not do for you. That's where it comes in. Originally, annuities were stream of payments. So you were buying an annuity, buying a stream of payments. But that only worked if you needed the stream of payments starting now. And so insurance companies are not stupid. They said, well, what about people that don't need the stream of payment today, but they need it 10 years, 15, 20 years in the future? Let's create an investment product where it is still going to be a stream of payments at the end, but from now until that date, it's going to be a tax-deferred investment. And so you put the money in today. You can either do it in lump sum or you can do it in multiple systematic payments, however you want to do it. And it will accumulate over the period of time between now and when you turn it into a period of a stream of payments.
So I'm sorry for
what's known as a deferred annuity.
Okay. So deferred. But what I would be doing then is I'm handing the insurance company some money now at age, I don't even know, 50, 55.
Any age.
I'm just trying to set this up and say, okay, here's some money. You hold it. Don't give it back to me yet. But when I turn, let's say, 65, I want to start. Why would somebody give an insurance company money 10 years before they're even going to start getting a payment?
Well, it depends. The insurance company says, will you give it to us today and we'll pay you X amount of interest for the period of time while you're waiting. Or we'll let you invest it. And by the way, you don't have to pay any taxes on those interest payments that we're paying you into the contract every year. So depending upon how you set up the accumulation period. So if we're talking about a deferred annuity, one that does not start making payments right away, there's an accumulation period, and then there's the payout period at the end, the annuitization area at the end. All annuities have a date where they will turn into a monthly payment or an annual payment. Normally, that's for a deferred annuity that's set at age 95, 99, and you can do things with it before you get to there. But at some point, every annuity out there has a final date, the annuitization date, where it has to start making payments. By law, that's what an annuity does.
Of course.
And so, but now with deferred annuities, they've set the date out there, like I said, 95, 99. Most people don't get to that date. But if you do, you're gonna get some payments. But in the meantime, all the interest or whatever earnings that you are creating and accumulating in that account are tax deferred. And so I could put my money into CDs, and let's say that, we're back in the day of the 80s and 90s when they were, paying 8, 10, 12%, or I could, and then I would pay interest or pay taxes on that interest every year, or I could put it into an annuity paying slightly higher interest rate and not have to pay taxes. In theory, that's going to accumulate more because that's not being whittled away by the expense of taxation on an annual basis.
So it just accumulates. I hand the insurance company a chunk of money, and they're crediting that chunk of money with an interest payment, and it's sort of building up over a period of years while it's being deferred in this deferred annuity.
Right. That was the second generation. Those were fixed annuities. Fixed meaning the principal is guaranteed by the insurance company, and they're going to pay you interest. That's what a fixed annuity does. The fixed annuity by the way, does not have any fees associated with it if you stay in it.
Okay.
The fixed annuity, if you put it in, the principal is guaranteed by the insurance company, and they pay interest. And if you get, now with all annuities, if you get out too early in the first 5, 6, 7, 8, however many years, they may slap you on the hand and say, we're going to give you a surrender penalty for taking it out too early. We're holding on to this money for X number of years, or you're going to get penalized.
Yeah.
That is something you need to look into and know what that is.
You've got to know what those are. Yeah.
Fixed annuities don't have any fees.
Okay, so we have the immediate type where I hand the insurance company over a chunk of money. They start paying me right away, next month, 6 months, whatever it is, but they start paying me right away, regular payments. Then we have the deferred type that we've talked about, where I hand the insurance...
fixed deferred we talked about.
The fixed deferred, yes, where I hand the insurance company a chunk of money. I say, wait, whatever it is, however many years, and then start paying me. And they will reward me for waiting that period of time while they hold on to their money by giving me what? Potentially more per month or year?
Well, they give you interest on a tax-deferred basis.
And I get to realize that once they start paying me that chunk of money. So,
right.
Okay.
And then when you annuitize it, that's in traditional world, the payment that you receive when you're 65, 70, 80, whatever it is based on whatever the account value has grown to.
Okay, so assuming it's grown, which of course I should say is not guaranteed anyway. Okay, so what else do we have? We have the fixed deferred. Let's move on to another type.
We got the fixed account that pays me interest, but for starting when I'm in my 30s and 40s, why would I start in my 30s or 40s saving for retirement and using an interest-bearing account? I want a growth account. And so insurance companies said, well, this makes sense. So let's create an investment account within the annuity where you can invest in stocks, bonds, and other types of growth or higher income assets. But we're going to take the guarantee of principal away. It's like investing in mutual funds. They're not in mutual funds. They're called sub-accounts because they're part of the variable annuity. But you now have the ability to potentially grow the cash value at a greater rate over time than you would achieve by getting an interest-bearing account. Now, with variable annuities, where the insurance company, with a fixed annuity, the insurance company made money because based on what you put in, the difference between what they were earning and what they were paying you in interest, kind of like a bank does. With a variable annuity, they can't do that. So to pay for all the contract and everything, they charge you a mortality and expense charge. Variable annuities have fees on them. Then you have to look at those and know what they are. Some are, fairly low. Some are fairly high.
Some could be substantial. Yeah.
Yeah. So you need to know what those fees are, but you get the privilege of investing in growth-oriented type investments or income type investments on a tax-deferred basis. Now, you don't get a deduction for putting the money in. It's not an IRA or a 401k, but it grows tax-deferred. And then at some point, you can start taking money out. And when you do take the money out, that's when you pay your taxes.
So we've got the immediate type, we have the fixed deferred type, and we have the type that you just mentioned, which was the variable type.
Right. That's a progression in history from the late 1800s till today.
Well, it was I guess it was a way for the insurance companies to look and say, well, what segments of the population are we not covering here? We want to get...
And then we picked up a final type of deferred annuity about 30 years ago, about 25, 30 years ago, a fixed index annuity. Now, when they first came out, they were called equity index, but that was a very bad name because it misled. And so we're not allowed to use that name, which I think is a great thing because it was misleading. It is a fixed indexed annuity. And because it's a fixed annuity, the principal is guaranteed. But the return, instead of the insurance company saying, we're going to pay you 2% on that annuity over the next year, the return that you receive, which will be an interest payment, the interest payment is based on the movement of an index. Could be the S&P, the Russell. I've seen interest rate indexes, gas, oil, gold, different indexes that they track. If it's up, you get some interest. If it's down, you don't get any interest. But instead, in today's world where a fixed annuity may pay 2%, maybe 3% if you go out longer, the index annuities have the ability to earn 4%, maybe 4.5%, still with a principal guarantee from the insurance company. So we've got fixed annuity, which is basically it kind of competes with CDs because they act kind of like the same thing. You've got variable annuities, which are more growth oriented. You've got index annuities, which are between the two of them, a little bit more growth potential, with maybe less growth potential if the index goes down. You just have to know what's going on. But there are key factors, and we've mentioned them a little bit. The surrender period is very important. How long are you locking your money up? And when can I get it back without a penalty? What is that penalty if I have to get to it early? What are the different moving parts in the annuity? If with a variable annuity, what are the fees and things of that nature? Those are the things that you need to look at and see whether or not they work within your world. Now we've got this whole other world of income, systematic lifetime income riders. It's a rider that they put on, and you can put it on any kind of deferred annuity, but it's a way to get money out on a systematic basis, guaranteed for the rest of your life, without actually annuitizing the contract. And the reason I say that is because annuitizing the contract, in the original ones, to get that money out on a monthly payment, we had to give up the cash value. We basically gave up our right. There's $100,000 in cash value in the account, and they're going to pay me that $7,000 a year. I no longer have $100,000. I just have a promise to get $7,000 a year for the rest of my life,
or whatever the number is. It varies,
or whatever the number might be,
depending on your age, right?
But if I a year later, if I decide, you know what, I put in 100, they've given me 14. I want the other 86 back. The insurance company doesn't have. They're not going to give you back because there's no cash value left on an immediate annuity. With this new generation of riders that came out 10, 15 years ago, 20 years ago now, it's a systematic withdrawal. And so it's a guarantee for the insurance company. You just have to know how they work. They work well for some people and horrible for others. It does change the taxation on the difference between a systematic withdrawal and an annuitization if it's a non-IRA type of an account. So there's a lot of moving parts and things to consider.
So
and you need to have somebody that knows what's going on.
Well, okay, in general, who should consider this? I mean, we've talked about the type that you're mentioning now. I mean, we could take an annuity and just say, I just want to guarantee an income, kind of like the original intent, right?
Right, but I want to have the right to change my mind and get to the cash value.
Yeah, so that's what this kind of hybrid,
the new ones do.
That's what these new ones do. We talked two things here very quickly. We talked before about how they're missold. Explain, if you would, how they're missold, and then let's get into who should consider potentially an annuity and who should not. Let's talk for a second about how you've seen them missold or misrepresented.
Well, like on the immediate annuity, when I was talking about you put in $100,000 and you get a payment of $7,000 a year for the rest of your life, they'd be told that, oh, you're earning 7%. No, I'm not earning 7%. I'm getting a payment of $7,000. If I don't live 14.2 years, I don't even get all my money back if it's just a pure life annuity. And if I live 14.2 years, I've gotten $7,000 back for 14.2 years back. I've gotten back $100,000. I haven't actually earned anything yet. Now, if I live a lot longer, now I'm going to make some more money. So it's unfortunate that math is part of this issue, but people get confused about it. The reason they changed the name of equity index annuities, because when they were originally coming out, they were being sold as get market-like returns with no risk. That's not true. You were getting no risk because it was a fixed index annuity and the insurance company guaranteed the principal. But the returns, if the market was up, like last year, the market was up 20%, whatever it was, a fixed index annuity may have earned 4 or 5%. Well, 4 or 5% compared to the market of 20%, to me, is not a market-like return. I mean, that's just what it is. So they can be manipulated in ways that sound better than they are. Okay. And unfortunately, unless you know what's going on, they can sound really good. Now, at times they work really well. So depending upon what you're trying to accomplish.
Yeah. So let's go now to the other side and talk about who should perhaps consider. I mean, where is the bad rap on these? Where do those people get it wrong?
Well, most of the bad rap comes from the fees. And most of the bad rap comes from variable annuities that are designed for growth with the sub-accounts, stock accounts and index accounts, but they're stock market oriented. But you have, a couple percent in fees for the annuity. that is where why would you pay fees to the insurance company when you could be paying us fees for managing your money? But I mean, so the fees are the big thing that really got a lot of bugaboo, for people, especially money management companies, like the big one that says never, ever, 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 don't pay a fee. Well, they're charging a fee. What's the difference? I mean, there's a difference. Part of that fee for a variable annuity pays for a death benefit. Now, the death benefit there's different variations to them, but basically it's what you put into it or what the last anniversary was. And so if the market drops by 20% and you unfortunately die, your heirs will get the bigger number.
But so you pay for stuff like this, obviously.
That's part of the fee.
Yeah.
I mean, you're paying a mortality and expense charge. So that's one of the fees.
So these fees can tend to eat into, if you're trying to buy this for growth,
eat into it.
They will eat into
the variable annuities. Fees definitely eat into them. Or if you're adding riders, the riders have fees associated with them. You have to look at it and say, is that fee worth what I'm ultimately getting or potentially getting from this particular contract? The fee for the lifetime income rider may be X, 1% or give or, something like that. Is it worth it to me to give up 1% of my return to make sure that if I start taking this money out and I live long enough that I deplete the cash value, that the insurance company will continue paying me or my wife for the rest of our lives? That may be worth it to you. Some people would say, well, I really don't need the income in that much, so I'm not going to pay the fee for it. It's used appropriately. They can work very well. But what seems like a fairly easy product to understand can get really complicated when you get into the weeds there. And you have to know how to use them.
Sure.
Or whether you should use them at all.
So my other question for you was going to involve, is it better to buy an annuity for growth or income? And I understand it probably depends on your circumstances. But let's say if my only concern is I just want a guaranteed income based on, the viability of the insurance company, all that. I just want to count on an income. And if I'm 65 and I could live to be 105, I don't know, I could live to be 68. But I just want to know that I have an income. Would that be an annuity of that type be
an annuity
suitable
can work in
for me?
that type. So it comes down to what, like you said, what we're trying to accomplish. If I want income. Now, when we do financial planning, we're looking at different income sources. And what we've found is that if you have enough income from outside sources that cannot change, that you have guaranteed for the rest of your life, pensions, Social Security, or something like these guaranteed fixed lifetime income annuities, if you have enough money coming in to cover your living expense, your basic, your wake up in the morning, the expenses, the insurances, basic food, gas, electric, things like that, and shelter. If you have enough money coming in from those outside sources to cover that, you become a less emotional investor for the rest of your portfolio. Now, you may need some more money for vacations and other things here and there, but that becomes variable. And so what we look to do in many cases is make sure that there's enough money coming in from these outside sources to cover the basic living expenses. And then we create the portfolio around you. But what studies have shown are that even though that maybe the rate of return on one of these lifetime income annuities isn't, double digits, it isn't, outrageously huge, the investor tends to have a larger legacy for heirs because they don't panic as much when we go through a 2000 to 2002, a 2008, or March of 2020, when the sky was falling and people run for the sidelines and pull out and do crazy things with their money. What we've seen is that works from an emotional standpoint more than a rate of return standpoint, but that equates, transfers over into allowing you to be a less emotional investor with the rest of your money.
And that's from the income side.
Now, if I've already got enough pensions and Social Security to cover all my regular needs, and maybe all my needs, I don't need one of these products. They are not good for just growth because the rider fees and everything else kills it. If I'm not going to use what I'm paying for. Why am I paying for it?
Because I've heard of people who say, I don't need the income, but I was told that I can use this to grow the money, even though I'm not going to use it. This will grow, and then I die when I'm 98 or whatever, however old I am, and my heirs get all of this growth.
If you're not going to use the income, don't buy the rider. It doesn't mean that the underlying deferred annuity is not a good or bad investment. It means that the rider is not for you. You don't need it. Don't buy it.
Well, why would I buy an annuity if I don't need any income at all? And you're saying they're not good for growth. Why would I even consider an annuity?
I didn't say they weren't good for growth. I'm just saying be careful of how you use them. And it depends on your risk tolerance. I may have some money that I have sitting in CDs because I just like the fact I like guaranteed money. The CDs are guaranteed by the FDIC. Maybe I can move that over to a fixed annuity guaranteed by the insurance company, not the FDIC, and earn a little bit more, maybe 0.25%, 0.5% more in today's world, or maybe more. I was looking at different rates, and the rate was almost double for a similar time horizon fixed annuity versus a CD.
That's the fixed index you're talking about?
That was fixed. No, it's just fixed annuity.
Okay.
Not fixed index, fixed annuity. And if I said, well, I'm willing to tie it up a little longer and I'm trying to get a little bit better rate of return, then the fixed annuity or fixed index annuity can make some sense. So there are reasons to do things, and it depends. I've met a lot of clients that say, you know what? I know I might not need it. I'm pretty sure I'll never need this money. I want it to grow for the kids, for the heirs, whatever the case may be. But at the same time, I can't handle seeing negative numbers on the return. I know that it's not going to affect me, not financially, but it sure affects me emotionally, and I do not want to see a negative number. Well, that means that growth investments are not going to work, because while they probably have the best growth potential over the lifetime, if it's going to cause anxiety, then you got to stay with something fixed or safer. And so that's where these types of fixed annuities, fixed index annuities, for somebody who's willing to take a little bit of variability, some of these index strategies, which are actually a form of a variable annuity. It's kind of a cross between a variable annuity and an index annuity. I mean, we didn't even talk about those.
Well, we can get too far.
There's lots of things out there, depending upon your risk temperament and your time horizon. Which
of course, you've got to consider that, and you really have to know what you're buying, which is why we're talking about this. Last thing on this, inheriting an annuity. Now, if you're going to pass this money on to your heirs, I'm not sure, and correct me if I'm wrong, I'm not sure. I'm happy to take any money I can get, of course, but I'm not sure that an annuity is going to necessarily be good for me. What is it? If you inherit an annuity, what are these? There have to be tax consequences with this.
Well, yeah. Now remember when I said that these deferred annuities, the income tax is deferred, and you don't pay any taxes until you pull money out. And death does not get us out of that taxability. Whoever inherits the annuity, whatever income has been deferred over those years, will come out, and it'll come out taxable to that individual. And it, unlike a stock portfolio or real estate or something that is a capital asset that grows over time, where currently a capital gain is eliminated when the owner of the asset dies, that doesn't happen in a tax deferred account. And the deferred taxability is still there. So if mom and dad put away, $50,000 in an annuity in 1990, and it's now worth $150,000 or whatever number it is, they never needed it and they die. Well, and I inherit it. Thank you. I like you said, I'll take it. I will pay taxes on that $100,000 of deferred interest that is in that account.
Do you pay it all at once? I mean, what happens to that money?
I take it out. So, I can stretch it out for a period of time,
okay,
but I'm going to pay it as it comes out.
So I've inherited this annuity that was $50,000 that they put in originally. It's grown to $150,000, so there's $100,000 of growth in this hypothetical example you've given. I've inherited this annuity. Does this mean, can I just let it sit there? Do I have to start taking money out?
You do have to start taking money out. There are rules. There's a period of time. It's not going. You can't necessarily, although the rules have been loosened up a little bit over the past decade, where you may be able to stretch it out over a longer period of time. But most of the time they're paid out over the next 5 years. Are
they paying me the growth first? Is it last in, first out? Is it a combination?
It's technically last in, first out. I mean, there are some caveats to that, and it depends on whether I'm inheriting a deferred annuity or an immediate annuity, or the remaining payments of an immediate annuity,
but
I should say.
They're going to be taxable, you're saying, at ordinary income rate. So if I have to...
Whatever that taxable event is ordinary income, not capital gain.
Yeah. So if I'm in my peak earning years, maybe I'm in my 50s or whatever, 60s, and I'm making a decent amount of money here at this point, and I'm required to take this out. This could affect me. I mean, it's nice to have the extra money, but some of it could be eaten up in taxes. And I guess that's something else to consider if you're leaving money in an annuity for your heirs, money that you won't need. Is that right?
Under current tax law, yes. If I've got somebody who's 65, 70 years old, whatever, and they say that this money is money I'm never going to touch and I want to invest it and I want to give it to the kids when I die, not today, then in one of the discussions we would have is, well, let's invest it like the kids would invest it and let's let it grow. But that comes back to the temperament of the owner. If they're not willing to take any risk with it, now it's just a question of what do you value more? The return of an annuity potential versus a CD, or the taxation at death. And for the most part, they're going to say, I want to grow it as much as possible. And if the kids have to pay a little taxes, the kids will pay some taxes. They'll get over it. But it's just a matter of finding the right balance between risk, return, taxation, and emotional temperament.
So that all has to come into play when you're considering things like annuities. I know we went a little longer on this, but
it's what you have to consider when you're considering all investments.
Absolutely. This is just one of those things. When we bring up annuities, because as we said at the start of this podcast, they're often missold. They're sold as either the greatest thing in the world, or when I say missold, it means somebody who says, I'm not going to sell you one because I hate these things. I don't care if you need guaranteed income. Let's manage your money and we'll get you that income one way or the other. I mean, Professor, it's, unless you understand how these things work or you have an advisor who is explaining this to you, I got to think it's really confusing.
Well, it can be. Look at how much we've talked about in the last 15, 20 minutes, and we've just scratched the surface.
Yeah, I mean, you've got people out there who own annuities who probably should not, and you have people who should be considering them, but we're told
they won't because of the name has such a stigma to it.
Yeah. So I hope at least by us giving you what the basics are that you've understood a portion of this and how this works. Some people understand how they work, and there are those who really should look perhaps a little bit deeper into these things. As you said, we can get into the weeds, and we're not going to do that here. But these are the things that you need to go over with your advisor, because at least you should consider. You need to know what's out there. You said tools, and we do consider annuities like a bunch of other financial products as tools. It can be presented to somebody and said, look, here's what this particular tool does. What do you think? Does this work for you? I think it does, but what's your feeling on it? And so I guess, Professor Plum, what I'm saying is this is something you really need to talk over with your advisor.
With an advisor that you trust, and they better know what they're talking about. Luckily, we've dealt with these things for decades upon decades. We're very good at understanding what's going on with them, but they are complicated. They are not the greatest thing in the world. They're not the worst thing in the world. They work in certain situations, and they don't work in others. What situation do you have?
Yeah,
I would see what works for you.
Maybe you go to your advisor and you say, what do you think about annuities? And see if they give you an absolute answer, like they're horrible without even considering it, or they're the greatest thing in the world. Maybe you should consider talking to somebody else about it. Like Professor Plum. Professor, you've spent some extra time here, but it's important, as I said, because I know you understand how this works, and the important thing is to educate people and make them a little bit smarter. If you'd like to get in touch with Professor and find out, maybe you've been considering, you've heard about annuities, but you've heard bad things, or you've heard only great things. You want to know, is this something that I should even think about? Take a few minutes to talk to Professor Plum or any of the Lucia Capital Group advisors about that if you haven't done so already. 800-644-1150. That's the number at Lucia Capital Group, 800-644-1150. It's important to go over every aspect of your portfolio. One of the things you said, Professor Plum, was guaranteed sources of income are one of the foundations of somebody's financial plan. It's one of the first things you look at, I would assume, when you're putting a strategy, a plan together for people, right?
Well, we have to look at those areas to make sure that we're investing the rest of the portfolio appropriately.
And that's exactly what they strive to do. 800-644-1150, or go online, luciacap.com, LuciaCap.com, Lucia Cap, as in Lucia Capital Group. Professor, I thank you for spending the extra time. I'll pay you a little bit of overtime here, one way or the other. Maybe I'll buy you an extra bag of peanuts next time. Who knows? But anyway, I thank you for being here. If you have any other questions, as I said, contact us, talk to us. We'll be happy to do it for you. Professor Plum and the advisors at Lucia Capital Group, they do this every day. For Professor Plum, I am Johnny Dean. Thanks so much for listening, and we will talk to you again next time.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy, including the investments purchased and or investment strategies devised by LCG, will either be suitable or profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the presentation or any component thereof serves as the receipt of or a substitute for personalized advice from LCG or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Fixed index annuities are complex, long-term investments designed for retirement purposes. Generally, returns are based on a market index and are limited such that an investor does not fully participate in market performance. Withdrawals may be subject to surrender penalties or foregoing benefits if withdrawn prior to the contract term. Variable annuities are long-term investment products designed for retirement purposes. Variable annuities with guarantees are available through optional riders at additional cost. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59 and a half, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Annuities guarantees are based on the claims paying ability of the issuer, subject to their terms and conditions. Investors should speak with a financial professional about the contract's features, benefits, risks, and fees, and whether the contract is appropriate for the investor based upon his or her financial situation and objectives. Investors are advised to carefully consider the investment objectives, risks, charges, and expenses of the variable annuity or indexed annuity and its underlying investment options before investing. The applicable annuity prospectus contains this and other important information about the annuity and its underlying investment options. Please read the prospectus carefully before investing. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall. Financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. A mutual fund is a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities. Mutual funds charge annual fees called expense ratios and, in some cases, commissions, which can affect their overall returns. Investing in a share of a mutual fund is different from investing in shares of stock. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other important information, call your financial advisor. Read the prospectus carefully before investing. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. Russell 2000 Index is a small-cap index consisting of the smallest 2,000 companies in the Russell 3000 Index, representing approximately 8% of the Russell 3000 total market capitalization. An investment may not be made directly in an index. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59 and a half may also be subject to a 10% penalty tax. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.